Welcome to the Aramir Roundtable. Today is the 6th of February 2019, and I've got my guest, the whole crew from Blackpier Capital is with us. So welcome, gents.
Glad
Hey.
to be here.
Thank you.
They're going to be talking about what your option trades aren't telling you. But before we get into that, normal disclosure that Aramir Corporation is not a broker-dealer or an investment advisor. This is for educational purposes only. Options involve risks and are not suitable for all investors. Past performance is not indicative of future results. And if you'd like to read the whole disclosure, pause the video or go to the bottom of any of our websites. So with that, I will stop sharing and then you guys can share and do your disclosure and start your presentation.
Okay, I'll pick it up here. Let's see if I can. Let's see here. Perfect.
Okay, and I see your presentation, so we're good to go.
Great. Thanks, Tom. Welcome, everyone. Again, my name is Ryan Moffet. I am the founder of Blackpier Capital, and we're going to talk a little bit about what your options trades aren't telling you. Hopefully, this adds quite a bit of value to trading, and we've got a lot of good ideas we're going to build throughout the presentation. First, we'll go through our small disclosure. Again, it's for educational purposes only. Trading has a high degree of risk. Blackpier Capital and all individuals affiliated assume no responsibility for your trading or investment results. All the strategies, indicators, columns, articles, and all other features are for educational purposes only and should not be construed as investment advice. Blackpier Capital does not recommend any trades presented, and the use of trades are hypothetical. And just like Tom said, if you would like to read the entire disclosure, you can pause the video and go through it. A little bit about us, Blackpier. What we are is we are a private boutique trading firm, and we manage options exposure related to markets for specific individuals and entities, and we do that through private partnerships, SMAs, and for our own proprietary account. So we trade for a living with our partners. Who is Blackpier? And you're going to be hearing from all three of us today. This is going to be the trading and investment side of Blackpier, which is me. Obviously, I am the founder of Blackpier and manage really the portfolio side. Tyler is trade systems and execution, so he's a wizard when it comes to processes and systems. And Wayne, we call him the mad scientist, strategy development and research. And I will say, having a team of traders like this and working as a team, and Aramir obviously does a great job of this, of community. The whole really is much bigger than the sum of its parts. So having a trading team is very, very important in trading. So I would encourage any trader that doesn't have a group to be with, and again, Aramir has a great community, to seek out some guys to trade with. It makes a big difference. And the amount of output that we can get done at Blackpier because of our team, you know, day in, day out, what we do is we look to make our strategies better and better, more robust, and we do that obviously to add value to our partners. So that begs the question, why are we talking about this presentation today? What brought it up? Well, we look at our strategies and we follow our strategies obviously on a daily, weekly, monthly, and yearly basis. And we do that. We have a ton, millions of data points over the course of a couple decades. And what that does, it gives us expectations of our trades and what we call trade integrity. And with that expectation, it gives us kind of a funnel to look at, is as long as our strategies are working, our positions are working in a certain expectation, a certain integrity, because we know no strategy works all the time. And but we know that they should act in certain ways in certain environments, whether it's high vol environments, low vol environments. And so with that expectation integrity, what we started noticing statistically is late 2016, 2017, some things started to change. The integrity of some of the positions started to change a little bit. And obviously we'll go through all this throughout the presentation. And then in 2018, we started seeing statistically the data telling us that there was some changes going on within the integrity of some of the positions. So that's something that we wanted to bring to light and do a presentation on in some of the research that we've done to help the overall trading community, because we feel it's extremely important for any complex options trader. And with that being said, again, with Aramir's community, I think everyone is there, but this does assume a kind of a mid to a higher level of options trading experience and knowledge. So there's assumption that there's an underlying foundation of some options knowledge. So we're going to refer to Greeks and structures. So that being said, we're going to walk through, Wayne's going to take over, and we're going to walk through some ideas. and then Tyler's going to take over and walk us through some examples. So hopefully you guys get a lot out of this presentation. And with that, I'm going to leave it to Wayne to ask kind of an odd question that you may not have asked yourself, but we think it's a really good question to ask and start us on this presentation. So Wayne, take it over.
Yeah, thanks, Ryan. So the question that I ask is, are you smarter than a pigeon? And, I don't ask this to sound insulting or anything. Actually, I ask this question to myself a lot just because of one of these experiments that I'm going to go through. And sometimes, very regularly, I realize that I'm not smarter than a pigeon at the time. So I studied behavior analysis at University of North Texas, and behavior analysis is the study of the effect of an external stimuli on the behavior of an organism. Now, that sounds really sciencey, but really what it comes down to is, if I poke you, what do you do? So one of the experiments that always rung a bell when dealing with the markets, actually pun intended there, was the pigeon test that we did. And the setup for this experiment was we put a pigeon in a box, and this box is called a Skinner box. And he's supposed to hit this little key. And when he hits this key, he gets a seed. We trained him to do this over time, which was actually pretty fun. But the actual experiment was to see if we could get him to continue hitting that key without giving him a seed anymore. So we did this in a few different ways. First, we stopped altogether. With every key hit, we didn't give him a seed. And what ended up happening was the pigeon just turned around in circles and said, you know what, I'm just going to stop hitting this key. And it was really quick how fast he stopped hitting that key. Then the next thing that we did, we decided to change up the variable a little bit, and we decided to intermittently stop it. So what I mean by intermittently stopping is, instead of giving him a seed every time he hit the key, we'd give him a seed every other time. And then we'd stretch it out to every 4 times, and every 8 times, and every 10 times, and so on and so forth. And eventually, as we stretched it out further and further and further, he decided to stop hitting the key because it didn't work anymore. Now, it did actually last a little bit longer than if we just stopped altogether, though. So this was a positive improvement. So we started going a little bit further on this, and we did something that changed everything. And we added randomness to this. And randomness was actually really easy to implement. We just gave him a seed on average every 3 times, and then on average every 5 times, and on average every 8 times. And so what this did is sometimes he would get a seed back to back, or he'd get it pretty quickly or something like this. And the most unique thing happened when he got the seed. Instead of expecting the seed when he hit the key a certain number of times, which, by the way, these pigeons actually get really smart. They know when it's coming. Instead of expecting it, it was shocked. It'll almost jump up and like try to fly when it got its seed. It was excited. And so this actually added something really unique to this randomness, very similar to if you walk around a casino and people are sitting at slot machines. Still a box in a way, right? Just in a little bit of a different context. And when they hit a win, they get excited, and it's a random thing. And sometimes they go through a long period of time without getting a seed, or profit from the slot machine. So really, what was funny is I bet you this pigeon would still be hitting this key to this very day because it was thinking maybe this time. So really, what does this all have to do with you? And more importantly, what does it have to do with the markets? So if we relabel this experiment, and the pigeon equals us, the investor or the trader, key hit is a single trade that you put out there. And a seed is profit, a profitable trade. That's a good time, right? Then no seed would equal no profits, or even losses, which would actually work into a punishment. And then the scientist, this is the key right here. The scientist is the market. The randomness in the market is like the average reinforcement interval. And the scientist is got a little wheel back there, and he's slowly changing it this way and that way and this way, really messing with you sometimes. And we noticed a few things, just like Ryan said, that changed in 2016, 17, and 18. that might have gone unnoticed. Not much different than as a trader or a pigeon, not noticing the scientist is changing and tweaking the reinforcement interval back there. And if you go, throughout life and everything's all fine and dandy, and not realize that there's someone back there cranking the wheel on you and that things are changing, you can actually end up going down a dark hole. So Tyler's going to set up an example of how it's possible for us to be fooled like a pigeon. And then we'll go through ways to become smarter than even the scientist.
Thanks, Wayne. All right, so let's set up our own pigeon experiment. We know that we are pigeon, or the investor. We have the market, which is going to be the scientist. And so we need the seed. We need the reward, or the reinforcement interval. And to do this, we're going to come up with the trade. Before I cover the rules, we really want to highlight that everything that we're covering today is just hypothetical. We don't know if these positions actually produce a positive expectancy or not. The examples are shown just as a frame of reference and as an argument for what we're covering today. While these trades and the examples we're going to go over, they probably will make money in certain environments and will definitely lose money in others. We don't know if it actually has long-term positive expectancy, but for the sake of argument, we're going to pretend that these rules produce a positive expectancy trade. With that said, what we're going to cover is geared towards options premium sellers. The main example that we're going to be looking at today is a 100-point wide condor. And that condor has three main edges that we're going to bring back into at the end. As we have our delta edge, our theta edge, and our vega edge. And so we're going to track those and see how the scientist is going to affect those edges with subtle little changes. Our rules are going to be that 100-point wide condor, and we're going to place our shorts 25 points above at money and have a negative 300 delta to start. We're also going to have some adjustments that we'll do. We will move our position back at the lower shorts and roll it up at the upper shorts, as well as adjusting our delta if it hits negative 400 or positive 100. One thing to note is we're going to want to adjust our delta before we reach our shorts. We're going to pretend that we have $100,000 of capital at entry and start this at 29 days to expiration. We're going to run this as a back test from 2007 to 2016. And this time period for back testing is very, very rich. It gives us a whole range of market environments from the bear markets and Great Recession 2008. We have a flash crash in 2010, very, very low volatility grinding up market 2013, some sideways in 2014, and a couple of other large volatility events all in this data set. So very rich in that it will show us how robust this rule set is. Taking a look at what this looks like on a risk graph, we have our $100,000 of risk, our starting delta of negative 300, and the shorts 25 points in front of the market. And once again, we have our adjustments that we're going to be doing before we reach our roll points, which are our shorts, of positive 100 and negative 400. I'm going to hand this back to Ryan, and he's going to run us through our hypothetical back test to see what kind of expectancy that this trade will produce.
Thanks, Tyler. So let's assume, again, we run it through our back test. And I think a lot of traders, newer traders, that's when you put together a strategy, that's what you come up with some rules. And just like Tyler said, with the rule set we have, it's just for an example. We're throwing spaghetti to the wall. We're putting a structure together, just kind of like you would with the new trade, right? We're going to have our guidelines, and then we're going to take it through the data set. And let's assume that when we take it from 07 to 2016, that we really like what it looks like. We really like the equity curve of it. We're very comfortable with the drawdowns and the risk reward of it. And we look at the data set of 07, 2016, like Tyler mentioned, being very rich. So we've been through a crash. We've been through one of the biggest crashes in the history of the markets. And so we've seen high volatility. We've also seen very low volatility. We've seen up markets, sideways markets. So we feel that that is an extremely robust test and data set that we have. And within that data set, you know, with the back test, our strategy did just fine. So we're going to assume that it works long term. And let's make some money. Let's turn the printing presses on. We're going to obviously retire early. We'll tell our friends and obviously defy all the institutions. With that being said, let's go ahead and pump the brakes a little bit. So we put a big, bold weight on there because one thing that we've seen is traders, you know, you put yourself through the data set, but we also want to sit there and we want to start asking some really, really tough questions about this data set. And we want to start stress testing any new idea we have. So at Blackpier, one of the biggest things we want to do is we want to break our strategies, and we want to break our strategies quick. And so in order to do that, we need to start asking the right questions about the data set and our strategy and how it relates within that data set. So first of all, does it only work because of a few data points? Could have some of the winners turn into an overall loser? That's a good question to ask. What constants were in the market during this time period? And that's something we're really going to dive into in a little bit. Will those constants continue? And again, one of the best questions to ask any strategy is, how does this thing break? Because I want to figure out how it breaks. Otherwise, the market's going to figure out how it breaks. It always sniffs out weakness. So in essence, our goal is to take our strategy and take it from this, which I think everyone's pretty familiar with, the paper airplane. And I don't think anyone would confuse and say a paper airplane is very robust when it comes to a flight, because if you throw a paper airplane, a little gust of wind, any certain change in the environment will push it in an entirely different direction or bring it crashing down to the pavement. So we want to go from this and turn it to something more like this, which, Tom, you probably are pretty familiar with this sort of aircraft. It's going to be a little bit more robust than a paper airplane. This is the A-10 Warthog. Very well known to be one of the more robust aircrafts. You see the picture here of the engine blown up. The pilot was ever able to land the plane. And stories of these planes coming home with really wings that look like Swiss cheese being shot up, but they landed just fine because they were tuned to the environment that they're in. So a gust of wind, not going to really make a big difference to an A-10 Warthog. Even bullets, even the robustness of it takes care of those questions, and they ask the questions, what are we missing here? So that's what we want to do with this data set. So how do we go about doing that at Blackpier? So step one for us is we always want to vet the strategy, and we want to start isolating the variables that can change in the market and that's going to affect the strategy. So again, we want to be like scientists testing our hypothesis. So what we've done here is we've just listed out some variables that we could think of, obviously, that happens in the market and that can change and affect the strategy. So volatility, obviously, asset price, volume, a trending market versus choppy market, liquidity, skew. Obviously, as options traders, you got to be aware of skew. Time frame, government rules, institutional behavior in row. Maybe those things don't come into a big time play at this point. Margin requirements, ability to execute over time and scale. Obviously, once you get bigger, those things can affect you. So this isn't the entire list, obviously, but we did want to list out some. But what we're going to do, especially during this presentation, is really focus on volatility and asset price, the first two up there. And we're focusing on those two because what we've found, especially over the last 2.5 years, that those two variables have had massive effects on complex options positions. So we're wanting to isolate these two variables. So we want to pull these two variables out and isolate them with our example position to see how it affects the position. So what, in essence, we want to do is we want to go from a picture like this. So we want to take and see if there's any tiny cracks in that data set that we looked at. So from 07 2016, was there any tiny cracks that we have found? And what we want to do, we want to take those tiny cracks and blow them up to something that looks like the Grand Canyon. And we want to do that by taking these variables to extremes. And we'll show, Tyler's going to lead us through that. But basically, either we're going to do that with our strategy or inevitably the market always will. And I think that's something that a lot of traders have started to see, is those cracks starting to get bigger and bigger and bigger. and we'll show some examples on why that's starting to happen or has happened over the course of the last couple of years. So I'm going to hand it over to Tyler, and he's going to walk us through the two isolations. First of all, he's going to isolate volatility with his example position, and then we're going to isolate asset price with his example position, and we'll see how, with our current rule set, we'll see how it works when it's pushed to extremes. So Tyler, I'll hand it back over.
All right, so like as Ryan mentioned, we're going to isolate our variables, volatility and asset price. First, though, we're just going to take a look at our original setup where we just had our $100,000 in capital, negative 300 delta to start, 25 points in front of the market. This is just to have a frame of reference as we start to isolate our variables. We're going to isolate volatility first by looking at two different environments that have the same asset price. So to get that, we looked at a time period where, and I believe it's 2017 versus 2018 in low vol versus high vol. So first, let's take a look at our low vol setup. First thing to note here is we have a very, very low peak. It's about a 1 to 10 risk reward. And generally, if you've been trading options for a while, we know that low volatility is a difficult time to be an options premium seller. There's not a lot of quote unquote meat on the bone. Let's compare this low vol environment with our high vol environment. You can immediately see that there's a drastic difference in the risk reward of the actual structure, where we went from about a 10 to 1 to about a 1 to 1 here. Whereas we know that a high vol environment is typically a good time to be an options premium seller. There's plenty of premium around, volatility is high, there is a lot of meat on the bone. So the question we want to ask ourselves here is, are there any cracks that are showing up between extreme low vol and extreme high vol? So looking at these two trades side by side, let's look at where our adjustment points are relative to where the shorts. If you remember from our original rule set, we wanted to be adjusting our position before we reach our shorts. First, let's look at our low vol setup and our risk at our roll point. When we're hitting our first roll point to the upside, in low volatility, we're down about 15% on capital for this position versus our original position was down about 8%. So in low volatility, when we're hitting our roll point, we're getting very close to what we would start to consider a max loss for this position. So we're not actually able to reach our roll point before taking on significant risk versus our original position. And then in high volatility, looking at our back adjustment versus our back short, we're actually hitting the rollback point before we get to our adjustment. And while this isn't necessarily a bad thing, it is changing the integrity of the trade to where our rule set, how we wanted to manage this trade, was adjust on our way back. But the market has changed that on us. So this is just a small little crack that's starting to show up in low vol and high vol of extra risk in low vol versus our original position, and changing our adjustment slightly on us in high vol. Now that we know some of the small changes that volatility is having on our positions, let's look at what asset size does. This is our same high vol environment that we were looking at on the rut on this on the last slide, and we're going to take this and put it on the NDX. We really like to use the NDX because it's about 5 times the size of the rut. Has about the same skew shape, about the same volatility, and it gives a good approximation for answering the question of what if the Russell goes up 5x? And as a frame of reference, the Russell from the bottom of 2009 to the end of our theoretical backtest in 2016 went up about 5x. So although this seems like a big amount to increase, it has happened in a past data set over a 10-year span. When we put these same rules on the NDX on about the same date as this Russell setup, we put it on there and the trade breaks. We can't actually get to our original rules. Most notably, our delta is only negative 150 versus our target of negative 300. Our front shorts are about 0.3% in front of the market, as opposed with our original setup about 1 to 1.5%. This means that the second we put this position on, 15 minutes later, we can be rolling it forward. And then looking at our back shorts, we're about 17, 18% behind the market with these back shorts, as opposed to about 5 to 8% with our original setup. You can see here the asset size completely breaks the trade. And the crack becomes very apparent here of a larger asset size is going to change how this sets up. Looking at the two trades side by side, we can start. Next thing we want to look at is what a 2% move to the upside does to each individual trade. On the NDX, 2% move right here is about 140 points, and it's going to give us approximately about a 30% loss on the capital in the trade. And a 2% move on the rut, about 30 points, is only a 10% loss. Also, to make matters worse, we only had 150 negative delta in our NDX setup. If we actually were able to get to negative 300, our loss would be closer to about 50%. So a 2% move is a drastically different outcome in our low asset price versus our high asset price. Now, I mentioned at the beginning of this that the Russell 2000 from the bottom of 09 to about the end of 2016 went up about 5x. So why didn't this position break in the Russell? Why are we still able to get our trade on in the ruts in this time period, although we saw a increase in asset price of 5x? And what happened is there was a fake out. There was a relationship that we were dependent on that masked the problem. And what masked it is the relationship between volatility and price move or asset size. In this first box, we're looking at the relationship between how many points does the market go up versus how much does volatility drop. In 2010, for every 8 points the market went up, we had about a 1% drop in volatility. In 2012, for every 6 points we went up, we had about a 1% drop in volatility. And in 2013, for every 12 points we went up, we had a 1% drop in volatility. On average through this time period, we can say that about for every 10 points the market went up, we had a drop of about 1%. And then in 2016, things started to change on us. We had for every 33 points we went up, we had about a 1% drop. In 2017, for every 48 points we went up, we had a 1% drop. And in 2018, for every 26 points we went up, we had a 1% drop. With this, it's very important going back to thinking of our delta, theta, and vega edge. If we're used to the market going up 8 points and volatility dropping 1%, on the upside, we're used to that value coming into our position, the upside not being as rough on our P&L. But all of a sudden, if we're going up much, much further with volatility only dropping us by that same 1%, we actually are taking on more risk to the upside than what the position had originally accounted for in the first part of our backtest. So all of this can be seen really well in a graph of ATR, or average true range. And this really highlights where the breakdown happened and what our relationship was. So average true range is measuring how many points is the market moving around. It's a combination of both asset size and volatility. As you can see, from 2007 to about mid 2017, late and into 2018, or even all the way back to 1998 for the matter, is we have been in a range of a relationship of volatility to asset price, to where we were dependent upon the market staying in this range with our rule set. And then the Grand Canyon opens up in 2018, where we have an extremely high asset price and extremely high volatility, to where the moves become much, much larger than anything that we had seen in the past. And our rule set that had been theoretically working through 2007 to 2016, where we had all these great environments to see if our rules would work in different environments, breaks down. So tying this back into our pigeon experiment, the scientists changed the variable on us. Our relationship between volatility and assets price changed. This is going to affect our delta, vega, and theta, where now we are having bigger and bigger delta moves. Thinking back to the comparison of our high asset price and low asset price, where in the rut we were taking 10% risk to the upside, and the NDX we were taking 50% to the upside on a delta move. Our vega position is also changing. Now it's taking a larger point move to the upside to get that same 1% drop in volatility. And also our theta is changing on us. Because we're in that static 100-point wide condor, as the market gets larger and larger and larger, our points on the skew are getting tighter together, which is changing how our position is going to be decaying. I know I went through a lot of information here, and I'm going to hand this back to Wayne, and he's going to help us take all these ideas and apply them back into our trade. Answering the question of how can we use this information?
So exactly like Tyler said, what really to do with all this info, and it's a lot of info, and it's maybe structured in a way that isn't so commonly used, but it's the thing that we want to look at are what did we actually get from some of this information, and we realize that our original trade structure is flawed in a high vol, high asset price. It's flawed in a low vol, low asset price, the opposite of what we saw even with what's been happening historically and lately. This trade worked because the markets remained in a range of that 10 to negative 1 point vol relationship, and it started to break down when we started to see it slightly different, actually. And always when I'm seeing this little hypothetical trade, our goal is for us to make profits over time and in the longevity of time, with the trade's integrity remaining the same no matter what changes in the market. We want to adapt and move just as fast as the scientist is tweaking so that we can always remain and get all the seeds we want. We don't want to do 50 pecks for a single seed. We want to get a seed every time we peck as much as humanly possible and love it while we're doing it. So, and then lastly, as we're taking in all of this trade integrity, we want to make sure that our edges that we're using in our trades, our vol, our negative vega, our theta per risk on a directional basis is all in balance, and it stays in balance no matter what happens, no matter what the scientist does. Well, how did this trade become off kilter? What happened to the integrity of this trade? Well, speed happened. And yes, holy crap, there is more Greeks. There's another dimension of Greeks. They're the third order Greeks. There's plenty of material for mind experiments that you can meld over in your head if you want to stay awake all night playing math and visualization experiments for hours of fun. But for the sake of not sounding like a lunatic while explaining my mind experiments, I'll just draw out a simple drawing that illustrates how speed can affect our edge risk balance and the static rules that Tyler laid out for us in the beginning. So speed is the change of gamma as the price of the asset changes. And I think that we should replace that. Let's not do price of the asset. Let's do size of the asset. So that's what we're going to draw out here. So the first line up here is when the asset was at $300. We had our little 100-point spread on here. The rough volatility is this blue arrow, which is 20% volatility. And our spread works beautiful. Actually, everything's really nice. Our directional risk, we've got nice profitable. We've proved that it's actually profitable. Well, let's fast forward 10 years. And now the asset's grown roughly 5x. Well, now that the vol is actually significantly less, so the vol is, around 7%, 5%, jumping around from there, and the asset's now 1,500, our 100-point spread still works. It still works because the movement in the market, this little blue line, actually isn't that much bigger as a proportion to the size of the entire asset. Well, what happens if our asset's now this big, but we go back to the original 20% volatility while we're this size? Well, our little 100-point spread blows up. Everything's going crazy. Things are moving so fast, you're moving your spread up, down, left, right. It's just panic. It's panic on the streets. It's blood. It's And actually, really, all the asset did was go back to 20% volatility, and our trade, our little 100-point spread, wasn't adapted properly. The directional risk wasn't adapted properly to the coming back to a 20% volatility in this asset size. But then what actually we can do is size the spread appropriately, size our directional risk appropriately in proportion to what it used to be back when there was a 20% volatility and a 300-point index. And now the trade's integrity looks the same. Everything looks extremely normalized. Actually, this is just another day in the office. And that's the best way to trade, when it's another day in the office, because then you can concentrate on other things and no panic and no blood in the streets. So now that we can see the drastic issues with our rules during the periods of extremes from our baseline data, how do we fix it? Well, this is where those late night mind experiments come in handy. So we got to build speed into our original rules for this strategy. Well, we need to measure it we need to measure it appropriately. We can do this with a ratio like vol to asset price, like what we did earlier. And we can also do this with ATR, which was the other graph that Tyler pointed out. ATR is a really beautiful measure because it ends up taking into account the size of the asset and its historical volatility. Now, granted, it is historical volatility, so you're always kind of looking backwards a little bit, but it does keep things in tune pretty tight. Then what we do is, once we get a measurement that measures both volatility and asset in their relation to each other, once we have that measurement down, then we can normalize our edge to the risk based on the change from the baseline. So what's the baseline? Well, our baseline is, let's look into our data and find where we were the strongest. Let's find where we lost the least amount of money, made the most amount of money, and had a really high probability of success during those times for the environments that were different from each other. Once you start getting down where the actual proper ratio was, so for this one, we're just going to say that we dug through all of our data, we dug through this test, and we found out that actually a 10-to-1 point up to negative volatility drop was where our trade was the strongest. And we started out at a negative 300 delta. So this is a really good spot for us. Now, what we do is we project that forward in proportions, right? We take it, so if the ratio turns to a 30-to-1, so basically if the market's moving up 30 points to every 1% drop in volatility, we need to decrease our directional risk because our edges are getting tweaked out. And so instead of starting at a negative 300 delta, we start at a negative 100 delta. That way everything stays in proportion. Then we can do this for the size of the spreads, the starting position, the moving points, all those little static things that Tyler talked about earlier that seemed dynamic, that they helped and they moved, but actually there were slight cracks in them because they weren't quite dynamic enough to every relationship that matters a lot to your trade. So looking at our original rules on a table, we can see the dynamic shift of all of our variables. With capital, we remain $100,000. We're not going to move capital, although capital can change drastically how much risk you take on. For this experiment, we're just going to leave a little $100,000. Well, for the spread of the width, and what I mean by the spread of the width is not the spread in between the two verticals, but the actual vertical widths itself on either side of the vertical. we go, instead of a single 100-point wide, we go to, well, let's add 100 points for every 10-to-1 change. So if we go from 10-to-1 to 20-to-1, we'd add 100 points wide, and so on and so forth. For our starting delta, we have a -300 at the baseline. So anytime that we see a 10 to -1 relationship, we'd be -300. But then what we need to do is we can change it. Instead of just doing it like the one before, we can change it to something like this, which is a multiplication, which is very, very tight. We do -300, which is our starting delta, times the new ratio that we see, divided by the original ratio, and it'll give us the proportion that we need for our starting delta. Then our starting position, instead of 25 points above the market for our upper shorts, let's do it to 25 points times the change in the ratio, however much the ratio has changed. And that'll give us spread out a little bit more to where they stay in proportion to where they originally were in the integrity works. As far as the rolls or the movement of the spread, we always were at the shorts beginning. Well, what's beautiful about this is when it tunes to the width of the spread and the starting points, your condor will actually widen out and tighten with volatility and size of asset. And so they're relatively going to be the same. It's going to tune with all the other parameters, so we don't really need to mess with it. Okay, enough with all the numbers. What does this actually look like visually? Because this is going to get this is confusing, right? So visually, let's go back to the original NDX setup where we were showing the size of the asset change and the points moves and everything was really breaking down. This wasn't even working at all. Well, let's actually take this and let's tune it. And what does it look like now? Well, you can see compared to the Russell, which is on the right side, and the NDX, which is on the left side, that's a 7,000 index over there. The points per move per day are massive. What's actually, you can see here, is that crossovers, points, risk-reward relationship, the trade's integrity is similar. In fact, the skew is similar. Where your shorts and longs are in relationship to each other are very similar on both of these assets now. The T+0 line, in proportion to all of the shorts and longs, are relatively the same. What's really unique about this is even though it looks like they're identical on left to right, these are two hugely different assets, two hugely different volatilities. The delta on the NDX one on this left side is only 61, whereas the delta on the Russell one is -300. That's how the relativity of the size of your spread can mess with visually how you see it. It's almost like an optical illusion. But when you tune these things properly, everything makes very much sense. The overall risk per move in the market is normalized and our edges are in balance now. If we add a new edge like high vol to choppiness, and the assumption is that in high vol we get a lot more back and forth and we want to increase our negative delta in that or something like that, something to that effect, well, then from this point we can sit there and go, okay, how much do we want that assumption to add to our risk? Do we want to have a 5% increase in negative delta during high vols of over RTX of 30 or something like that? And you can kind of create this assumption. But from here, you can change your baseline now. You can change your baseline up 5%. You can change your baseline up 10% and things like that. So now that you've got all this together, all of these assumptions in your trade seems to work and it's all in proportion and everything's really beautiful, and you think now you've got the Holy Grail. Well, actually, let's take this, let's send it back through the data set we've got, verify that the new parameters and all the risk rewards and you like your equity curve and it's still a winning trade and everything's beautiful. Then you can actually go forward with this. You know, there's lots of new experiments for you to do and validation tests if you've been trading something that might have some static points in it that could be breaking over time. The thing about this is that this might not look super extravagant, super sexy, super, it's going to give you tons more profits and things like that. But actually, you'd be surprised. It might give you a lot more profits, especially in certain times of the markets. And this is similar to like automotive maintenance. If you change the oil on your car, if you make it adaptable like what we're talking about, it can last the longevity that you need it to last. The car can go 1,000,000 miles instead of just 50,000 miles. So Ryan's going to lay out all of this and how to keep this in mind when trading and designing or pondering how to take over the world late at night. So I'm going to hand it back over to him.
Thanks, Wayne. So there's a lot of information, and one of the biggest things that we always want to do is drum up good questions to ask as traders. Questions are the answer. That's where you're going to get the real answers to situations. So like I said at the beginning, when we started seeing statistically things starting to change with, and we've said this word quite a bit, the integrity of our trades. And again, just definition and how we define integrity is the positions are acting as expected in certain environments. And so we want to make sure the integrity is being, kind of like Wayne said, projected forward. And whether the asset's at 7,000 or 1,000 or 500, we know that our positions are fully adaptable to it. So if it's a high vol and a 500 index versus a high vol and a 5,000 index, just like the illumination of that, you start seeing that the positions act the same that you would expect. They look the same. And so what I think a lot of people kind of started to notice in 2018 with the higher volatility is the positions starting to act, we've talked to a lot of traders, they say they act quote unquote differently. They're not acting the same. And one of the biggest reasons why is because of the static nature of some positions. And, point number one is we always want to be smarter than a pigeon, right? We want to know what the scientists, if it's tweaking the environments, we want to understand what's going on, and we want to make sure that we are adaptable enough in order to profit in the new environments. And so we want to do that by taking variables to extremes to illuminate these flaws. Again, any trader, what we want to do, we want to break our strategies as quickly as possible. We want to break them apart, see what the market can throw at it, what variables in the market will really have a lot of emphasis on our positions, and we want to isolate those and take those to extremes in order to take those small cracks and blow them up as big as we can. That way we can eliminate them. We can make it better, make it more robust. So I think one of the biggest points is any static points in any trade has to be examined, because the market is not static. It's just not. And one thing that I think a lot of people with options trades is, you can use delta parameters. If you've got a lot of different condor traders, or even the weird or and things of that nature, where you're utilizing delta to expand your structure or contract it with the volatility in the market, which is fantastic. That's a good variable component. But you've also got to put the other half to it. So your starting delta and the deltas within your points has to change with that in order for, again, the integrity of the trade to continue being the same moving forward. A lot of people utilize butterflies. We utilize butterflies as well, different structures, and making sure that it's very flexible within that, again, in order to have your same expectation moving forward, the same risk reward moving forward. And again, keeping that original integrity intact. So I put it in bold as a trader, the most important variable we control is risk. And we don't want to let the small changes in the market change our risk without us noticing. Kind of like slowly boiling a frog. It really doesn't notice until it ends up dying. And that's when our trade breaks. And so that's one thing we want to make sure of is any certain changes, any certain tweaks the scientist is making, we want to make sure that we are moving with those tweaks and understanding that our risk reward continues the way we planned on it, the way we designed it. We want to make sure that that's the same moving forward. So with that, that was really kind of most of the presentation. We want to open up for, I'm sure there's a ton of questions. We love to kind of talk. We love feedback. Here's how to contact us. If you want to contact us, info@blackpiercapital.com. But again, we wanted to put this out there, these good ideas, because again, we think questions are the answer, and anything we can give back to the options community, that's how we got to where we are. And again, we love feedback as well. So any feedback from us, questions, comments, concerns, we love to hear it. But for that, yeah, we're pretty much through our information, Tom.
Okay. Did you see the chat? There's a couple of questions.
Let's see.
If you go up to the top, you should be able to pull down a chat or like some dots. So it's a chat.
Okay, there it
I
is.
think I've got it open. I can kind of pass it around if you want.
Yeah, sure.
So, we got some simple questions, and then we got some more kind of getting into some of the little details. And, just curious, I don't know about this one, but this is just a general one. Have you guys read any of the Brian Johnson books? Ryan, you read a lot. Have you read any of those?
I have not.
Yeah. I'm not aware of them either.
I guess I need
Tyler?
to.
No, I haven't.
Well,
heard
it's
of him.
something that we need to read. I wrote it down, so I'll see what he wrote about and everything like that.
Yeah,
but,
we'll remedy that situation pretty quickly.
yes. So
He's a pretty good author.
What's he write, Tom?
He's very system oriented. He manages quite a bit of money. He's very methodical approach to things. I think he's written several books, so they're definitely worth putting in your library, or at least getting the Kindle version if you don't want to store them on a shelf.
Yeah,
for sure.
we'll take a look.
So are you relating the width of the condor to ATR? Tyler, you want to take that one?
Sure. That's definitely one way to do it. Kind of like we were showing, there's not a set in stone way to size the fly or change your adjustment parameters of the trade that we were showing. ATR is definitely one way to do it. We gave the way of doing it, adjusting it based on the relationship of price movement to volatility movements. Really, it's for everyone's trades. Choose what makes sense to you, what works, so long as it has the components that you're looking for, the variables that you're trying to control. All the measures are going to get you to about the same place. Just choose which one you think works best for your style of trading.
So funny enough, actually, while you were talking, I was listening to you, but I looked down at my desk and one of my friends that's getting into options actually handed me a book the other day. And, I was just kind of like, this was a really good book. I read down here earlier, someone talking about Trade Filters book. And I remember this book was a Trade Filters book. And I looked down at the author, and it's Brian Johnson. So I haven't read it, but I have it right here.
Weird how that works.
Yeah, funny enough, the universe is weird sometimes. So someone asked on here, do the tuned rules adjust after the trade is open? So what you can, just like Tyler said, you can do things in a lot of different ways. Make sure that, of course, we are very data dependent. So what actually works, what's going on while it's moving. As things go into expiration, there are, as you get closer to expiration, you're basically fast forwarding through time. You're dropping a synthetic volatility, things like that. So you can have things that tune down as the trade's opened. In a simple way, though, you can always do things as when they're just only when you're opening the trade, that you look at all those variables, you hold them static until you go through that trade, and you just you take it off at a specific time period or however your trade setup actually goes, until you move it out or something like that. Hopefully I answered that question decently well. I guess this is a statement. If you use constant delta levels, you have it without all the calculations, and then it goes real time. I'm thinking what it's saying is, we're talking about dynamic deltas and things like that. But at the same time, your models or whatever you use can be, obviously the market's moving and doing different things. And so you're moving around your gamma curve. And so, yeah, definitely adjusting in a traditional way is probably a good idea.
Yeah, and we're talking about deltas. A good exercise, because I know a lot of people in the community do fantastic work when it comes to backtesting, and something that really illuminated the fact of how much delta plays a part in you have to have a more variable delta. Take a position, or whatever trade you want to do, but a butterfly, condor, and just like we showed, take your trade, whatever trade you're doing, and if it's trade on the Russell, the SPX, put it with the exact same delta parameters on the NDX. And you start seeing really quickly that if you don't change your delta parameters, your risk skyrockets. your risk reward breaks. Everything breaks down. And so that's what we're trying to illuminate with this presentation, and we're trying to put a spotlight on, is because, you know, just like Tyler said, the Russell went 5x. It took 10 years to do, and it stayed within an ATR range that masked an overall problem. You start to boil a little bit like the frog. And so, you know, what we want to do is for people to test your strategies and go ahead and take it to the extremes in order to, again, to see those cracks. But you really start seeing really quickly, if you put, you know, let's say an easy one, just a butterfly with a call or something. I know a lot of people trade certain structures like that, and you put it on the NDX, you start figuring out, man, this is a totally different trade now, totally different. And so you start, I think the good questions to ask yourself is, okay, why is this breaking? Again, through the website, through the presentation, okay, what is breaking this trade? Wayne mentioned it was speed, and building that speed is like, okay, I'm taking it from the Russell to the NDX. It's the same trade. And what's really interesting is, you know, a lot of people had struggles with 2018, and not saying even if you tune your trade that 2018 would have been a fantastic year, anything like that. But what you start seeing, it acts just the same in high volatility as, let's say, 2007. The trade looks the same. It acts the same. You're getting the same. You're getting the same integrity within the trade. The options are degrading just the same way they did in 2007. That's what you start seeing. And so again, it means that you're more robust as a position. So I hope that clarifies a little bit, because that really shined a big light when we started taking it to indexes way bigger. You start figuring out what parts of the trade are static. And once again, if you're trying to be static in a dynamic environment, you may do well for a while. But again, we want to create strategies and structures that do well for the long term. And that's what we always look for here. So hopefully that helps a little bit.
Yeah. There was another question, you know, he was talking about some earnings book and stuff like that, but he asked, what tools do you use to do your back testing? Tyler, I know you and I spend an absorbent amount of time with all of this. You want to try to go over that? Yeah,
sure. We use a couple of different tools. Mostly, we spend probably, I don't know, 80% of our time in Backtester with option view of just trying to take things to extreme, doing different mind experiments, just really trying to break trades or adapt them to different environments. Like, you know, here we used the NDX as an example, but what about going to oil, where it's a different volatility, even different skew shape? You know, how is that going to affect the trade? What can you do to make those adjustments? So that's kind of what we're doing in Backtest. We use it, you know, we use option view. We have O&E as well as a backup. And there's also another great tool out there. If you're fluent in C#, there's an open source software called Turing Trader that is a algorithmic or a automated options backtester. So if you go, you can just Google Turing Trader and that should pop up. So yeah, between those three tools, and then really it's just it's what works for your trading and what makes sense for you to use. For us, we like the visual components of either the option view or O&E.
And then we utilize Excel like you wouldn't believe.
Oh yeah, Excel is just.
So getting the data, again, it's not sexy. It's just grinding, getting the data, seeing what works, and making sure that we're as flexible as possible within our positions. And you know, we talk about, you know, we'll come up, you know, Wayne a lot of times comes up with ideas, and we test them, and 80% of the ideas don't work. And that's, you know, that's why we want to break things fast, so that we know it doesn't work, because we'll get weeks and then thousands of data points and then figure out something doesn't work. But again, that's what it takes to get to something that does work, is you start figuring out. And a lot of times it's not just this incredible idea out of nowhere. It's iteration after iteration after iteration. And you start kind of figuring out, okay, this is working, this is not working. And on the millionth data point, you start figuring out, okay, this is something that will work. And again, we're not designing strategies that work all the time. There's no strategy that exists that works all the time. But we want a compilation of strategies in a portfolio that together give a fantastic risk reward. And so again, we'll design strategies for certain, certain exposures. And, we just want to make sure that whatever integrity that we have designing that trade, again, that integrity stays for the long term. So yeah, Excel, all the options programs that probably most people are familiar with. And, the edge with all that is just the process and the hard work, honestly. I mean, Wayne and Tyler, good Lord, they do a lot of back testing. That's for sure.
Yeah, and there is some automated stuff out there that actually makes things a lot easier. But there's a quicksand with automated backtesting is that a lot of times you'll make decisions based on results, and you'll get resulting biases. And resulting biases can be really dangerous because they might not be actually grabbing a fundamental edge that the way that it's supposed to statistically. So you can kind of run into a little bit of quicksand there. So there's another question on here. I get this is why a 50-point wide rut butterfly doesn't work anymore without a directional bias. How wide does your ratio calc make the rut trade in today's market? So
that's a good question.
That's
a good question.
Yeah, it's a great question. So what I would say is make sure that whatever width you're asking for is relative to your trading. I mean, so for us and where we go into the market and in different ranges, that width is super different. It just depends on how far you are away from expiration and everything, and just giving you an or like a number that means something to us would lead you down a rabbit hole. That's a terrible example. So do something that's relevant to you. If you have a 20-day trade, then I would say measure something that looks for 20-day windows and the ranges in 20-day windows, and that'll start leading you to a proportioned ratio that would actually mean something to you. But I will say, without getting into all of the details or anything like that, if you're doing like a 50-point wide butterfly at, say 40 days or something, 50 days out there. So you would be pretty significantly larger, probably pretty close to double currently. So,
and what, just like we were walking through the presentation and Wayne's illustration of the different asset sizes versus the different size positions, go back and see when the 50-point fly did work, right? So whether it's 20, and that's what we talk about baseline. So in your back test, not saying, it's an environment where it makes money all the time, but when it worked and the integrity and the expectation was the risk reward was good with you. And so walk through the back test. Okay, in 2010, from the 2008 through 2010 or 2012, it worked really well. Well, why did it work well? Well, the moves were at this point. Well, that's where you can start getting your baseline. And from that baseline, you can start extrapolating. Well, if you go off this baseline and create a ratio from that, and it obviously organically grows with the market or grows with volatility or both, then you start seeing, okay, now it's not a question of how big because your ratio is going to tell you how big. And so it's extremely helpful, but you do have to get that baseline, and you've got to kind of do the work to see, when this thing did work and was really doing within your expectations of your test and what you want as a trader. Some traders want more risk, and some want less. So whatever personally it is to you, you can get that baseline and extrapolate it to get your own ratio.
Mm-hmm. It looks like there's a continuation of the same topic. A question just popped up where the butterfly sizes differ with DTE. And kind of like what we were talking about earlier, of isolating variables and seeing how that's going to affect the trade. Time to expiration is definitely one of those variables that's going to affect the size of the position and some other things. When you go through back testing, come up with experiments to see how that time is going to affect a trade. Maybe try, what does a 100-point fly look like at 120 days, and what does a 100-point fly look like at 2 days? And ask yourself, okay, what's between these two extremes? What's happening in between here? How are these things related to each other? How are these related to time? And start digging into how the market's being affected by time. And there's even other things that are going to affect the DTEs in time, such as volatility is going to come into play. And there's a couple other variables. So it's isolate and then take it to extremes.
Yeah, so I'm going to keep going down the list that I was looking at. So, and I'm going to try to rapid fire this one because it's multiple questions in one, and then we'll get moving down because I know there's a lot of questions popping up, just like you saw, Tyler. So, do you think your methodology applies to smaller accounts with more non-systematic directional trading approach? So, as far as smaller accounts, yes, it does work for different smaller accounts. Now, granted, your capital limitations, depending on widths and things like that, can come into play. Also, if you're moving on just maybe like pure verticals or one option alone or something like that, depending on how limited you are, it's really important to make sure that your risk is in line with whatever you're trading. And so if you use something like, if you put a call on something like Tesla that's got a massive amount of volatility versus a call that's got on something like 3M or something like that that has almost no volatility, you're actually risking a lot more in one versus the other because of the amounts of point moves that you're expecting in a single trade. So normalizing that is actually a really important thing. How do you monitor market changes? Just like what we read on there, we monitor quite a few different ways. We monitor trend and chop, things like that. We do this normally through a fractal window. We have ATR or vol relationships and implied volatility measures on different time frames, short, medium, long term, and it starts to tell us a really good picture of the environment. What's our lag time? Our lag time is depending on what volatility. Some we've got forward-looking measures, some we've got backwards-looking measures. It just depends on what you're basing your trade on. And sometimes our lag time is a few days, and sometimes our lag time is 6 months back, depending on how slow we want the structure to take effect. Then I think from there, I think we are back down to Tyler's question. So I don't see anything more.
Oh, it's interesting. You guys talked about touring trader. Felix is going to be a guest in 2 weeks with us.
Oh, Felix is a great guy. That's fantastic.
Yeah, we're looking forward to it. Apparently he's German, so I'm in Germany right now, so we had a little conversation. But yeah, he seems like a great guy.
Yeah, he's actually here in Seattle. If we actually we talk to him every now and then, or at least I do, and so does Tyler.
Yeah, I think he said he's been in the U.S. for 12 years now.
Yeah, he was in LA for a little while, and he came up here, and he goes, "Oh yeah, it's so much nicer."
I was about to say, is LA even part of the U.S. anymore?
Yeah. Well, hey, gents, we're over an hour. I usually like to cut it off there. I don't like to take up people's time too much, but a lot of good questions. So I thought, let's go through the questions. But you wrapped it up. Great presentation. Really appreciate it, and nice to have all three of you on. So thanks for coming.
Yeah, thanks so much, Tom.
Thanks for having us.
Is there anything else you want to say before we wrap it up?
I'll just say if people want to reach out, again, I think our email's still on the screen with questions, feedback. We get as much from the community as we try to add. So reach out to us. We love talking shop, and hopefully we can help, and hopefully we can get help because, again, we don't have it all figured out, and we just want to present some of our ideas. So we always love to hear from the Airmare community. It's fantastic. So it's always good to hear from everybody.
All right. Well, thanks again, and we'll probably have you on in the future later this year if you guys have some time. All right.
Absolutely.
Thanks, everyone.